Good day, and welcome to the DoubleLine Closed-End Fund's webcast, hosted by Deputy CIO Jeffrey Sherman. Today's conference is being recorded. At this time, I would like to return the conference over to DoubleLine Product Specialist, Chris Stegeman. Chris, you may begin.
Thank you. Good afternoon, and thank you to everyone for tuning in to this DoubleLine Closed-End Fund webcast featuring, as Jenny said, our Deputy CIO, Jeff Sherman. I'll hand it over to Mr. Sherman in just a minute to discuss the macroeconomic landscape and our three closed-end funds, DBL, DSL, and DLY. But first, just want to touch on a few housekeeping items. Here we have our upcoming webcast schedule. You'll see on September 14th, Jeffrey Gunlock, DoubleLine CEO and CIO, as well as Portfolio Manager Andrew Hsu, will be hosting the Total Return webcast, where they will discuss markets, their outlook, and of course, the DoubleLine Total Return Bond Fund. Following that, on October 10th, is our Diversified Fixed Income webcast, also featuring Deputy CIO Jeff Sherman, where he will discuss markets, outlook, as well as DoubleLine's fixed income asset allocation open-end mutual funds and the DoubleLine Opportunistic Bond ETF, ticker DBND. You'll see in the top right there, you can register for upcoming webcasts at doubleline.com. And then today, if you'd like to receive a copy of the slides, simply click Request Webcast Content tab in the player. So moving on to other forms of DoubleLine thought leadership. First, we have DoubleLine's Channel 11, which is hosted by Portfolio Manager Ken Shinoda. That's available on YouTube as well as Twitter. Not sure if I should be saying Twitter, if we're referring to it as X these days, but nonetheless, we'll move on. Below that, we have the Sherman Show podcast, hosted by, of course, Jeff Sherman, but also Portfolio Manager Sam Lau. This is available on doubleline.com, iTunes, Spotify, and really all other platforms where folks will listen to their podcasts. That was also ranked as one of the top 10 must-listen investing podcasts by Business Insider back in 2020. Below that, another podcast available is our Monday Morning Minutes, hosted by PMs Sam Lau and Jeff Mayberry, where they discuss timely weekly macro and market recaps. And then lastly, we have PS Perspectives, which is a video series by our product specialist team, which explores latest thoughts on financial markets, macro events, and drivers of return. Also available on YouTube and doubleline.com. And you can always email fundinfo@doubleline.com if you ever have any questions on any of the DoubleLine fund offerings. So moving into the DoubleLine 3 closed-end funds to be discussed today, we just have a few performance snapshots. First, we have the DoubleLine Opportunistic Credit Fund, ticker symbol DBL. This was launched in January of 2012. You will notice this fund has outperformed the Bloomberg U.S. Aggregate Bond Index, which is its benchmark, in the second quarter of this year to date, and on a 1, 3, 5, 10, and since inception basis. As of June 30th, you'll see it had a 30-day SEC yield of 12.27%. Next is the DoubleLine Income Solutions Fund, ticker symbol DSL. This was launched in April of 2013. You'll notice this fund has also outperformed its benchmark over all the time frames listed. However, its benchmark is the Bloomberg Global Aggregate Index, as it does have a rather sizable allocation to emerging market fixed income, which Mr. Sherman will certainly get into. Year to date, as of June 30th, the fund is up 13.54% on a total return basis and had a 30-day SEC yield, again, as of June 30th, of 14.58%. And then last but not least, we have our most recent closed-end fund, which is the DoubleLine Yield Opportunities, which was launched in February of 2020. This fund has the Bloomberg U.S. Aggregate Bond Index as its benchmark, and you'll notice is also outperforming on all listed timeframes, up 16.31% year to date from a market price standpoint and total return. And as of June 30th, had an SEC yield of 11.64%. So with that, I will hand the reins over to Mr. Jeff Sherman.
Thanks, Chris, or as we call him around here, Stegs. We appreciate all you're doing for us on the product specialist side. Thanks, everyone, for tuning in today. What we're going to talk about is our closed-end funds. This is one we do annually, so thanks to all of you for tuning in for this. As usual, we're going to start off with the macroeconomic landscape. Obviously, we have a very important week this week as the central banks around the world, or at least in the developed world, are meeting today with a lot of eyes on what's going to happen there. And so, starting with the macroeconomic landscape, why don't we look at where central bank policy rates are today? And so, this is a chart we used to use many years ago. Thought we'd dust it back off again now that we've been in a hiking regime. And one thing that I found very curious about this is that nothing happens in a vacuum. And if you look at the various banks that we're seeing across here, it really seems like in general, when there's a cutting regime, it's happening across many banks. And when there's a hiking regime, it's coming across many central banks around the world as well. And so, not shockingly, inflation tends to be somewhat of a global phenomena. The reason being is a lot of the things we consume, we all consume, irrespective of the jurisdiction we live in. But what you see here is it's not just the Fed that's been on a torrential pace in terms of its hiking campaign. But if you look across the globe, you can see here that there's been meaningful hikes across most of the developed world. And so the one kind of standout or holdout here still is Japan. You can see there. We've color-coded this in terms of the extrema of the readings, and that's why it's red there. But you can still see Switzerland, even at 175, is still kind of that red, as it is one of the lower rates in the developed world here. And so if you take a look at the expectations, though, and what this does, this takes the last roughly 9 months or so, and I'm sorry, it takes the last make that 21 months or so, and looks at what the hiking process has been. It's just trying to give a sense of when the hiking regime started, having that flat line going in, but also importantly, see those dotted lines, and those are market expectations of where policy goes. And why I point this out is that it sure seems to me that at least from the market expectations, again, the market can be wrong. If you recall last year going into 2022, the idea was that the Fed may be able to hike 50 basis points over the course of 2022. And we all know that they delivered over 450 basis points of hikes. But you can see here that the market is starting to believe that in most instances that the central banks, at least the ones we're showing here in the developed world, are done with their hiking regime. You can see that the U.S. is not expected to be the leader. The U.K. At the Bank of England, it has that crown of being almost 6%. In terms of its terminal rate, at least from the expectations of the market. But notice that the market is saying that the Fed is likely to deliver a hike at tomorrow's meeting. And then from there, it's a coin flip whether or not they actually continue to hike from there. And so when you think about it, the expectations are why the Fed is trying to induce this hiking regime is to make sure that you can make things more restrictive. And one way of doing so is making real yields positive. And what I mean by that, borrowing costs are more punitive than the inflation rate. And so an example that you can see here on slide 11 is this shows the real Fed funds rate. There's also this market implied policy rate today versus where it was 3 months ago. That's the blue versus the yellow. But that gray or the blackish line there you see is the real Fed funds rate. And this is taken by taking whatever the current Fed funds rate is and subtracting the latest one-year inflation rate. So you kind of have a backward-looking inflation measure complemented with the current Fed funds rate. But essentially, it gives you a sense of are cost restrictive or are market conditions restrictive enough, and that is generating a positive real yield. And so take a look here. What you saw from the pandemic is that we had deeply negative yields here, right, in terms of real rates. That's because you had a very high inflation rate, you had very low Fed funds rate, and so you put those two things together. No wonder the Fed embarked on this high hiking cycle. Now, this isn't something that's costless. We all know about the increased borrowing costs of the U.S. government by hiking this, but one other thing to notice, too, is that you can see the impact it's had on the Fed's balance sheet. And so the Fed used to have what we call a positive carry trade. That is, they borrowed lower. That is, they had a lower rate that they were paying out on their deposits versus the assets they own. Remember, they were owning treasuries. The bulk of their balance sheet sits in treasuries and mortgage-backed securities guaranteed by the U.S. government. But you can see that changed as they embarked on this hiking campaign. One is the coupon on their portfolio is below the borrowing costs, and they continue to ratchet up those borrowing costs. So if you were a corporation, this is a good way to go out of business. But fortunately, the Fed doesn't have to suffer from that side. But there are ramifications of this. And for all of this tightening that the Fed has embarked on, there's another way of thinking about financial conditions. And Bloomberg does a calculation where they distill it down into roughly 12 different kind of metrics that they compare whether these are creating a more accommodative environment. So for instance, if you think about when high yield spreads are rallying or they're tightening relative to treasuries, well, that's actually easing conditions or more accommodative. And the vice versa scenario is when you have tighter conditions. You can see here that the bulk of these measures of the last, let's call it 6 or 7 months, have actually been more accommodative. Well, why is this? Well, interest rates were higher. They peaked late last year across most parts of the curve, and I'll show you this later in the presentation. They peaked in October of last year. The 2-year Treasury has kind of flirted with newer highs since that point in time, but 5s, 10s, and 30s, for instance, have been are lower rates today than they were back then. And so some of these ideas that effectively, even though the Fed continues to tighten policy, it's kind of led to a more accommodative environment because spreads have come in on a lot of these products out there. And so in general, what this does is that it almost flies in the face of what the Fed is trying to achieve here. And so remember, when you talk about Fed policy, the goal is to slow down the economy. By tightening conditions, the Fed is trying to engineer a slower economy. And that goes through two really transmission mechanisms. The first is making borrowing more expensive, right? We saw that in the Fed's own balance sheet, right? That if you have to pay more to borrow money, that effectively should slow things down, or at least make credit less attractive than it was prior to having lower rates. And secondly, it's to induce savings. And so those are the two things that the Fed is trying to do through the higher policy rates. And so we know that some of those first few hikes did not curtail the lending standards or did not curtail kind of lending out there in the economy because a lot of the debt was refinanced at very low rates or financed at low rates. But also, I think there was this kind of belief that from the consumer side that effectively that the savings rates weren't good enough to warrant what we've seen in the inflation regime. And so this was not really slowing down the overall policy, or the policy itself was not slowing down the overall economy. And so we'll have to see how some of this continues to play out. But let's take a look at some of the measurements of economic activity. And if you take a look at something called the Fed's, the New York Fed puts out a weekly economic index. That's the blue line on the graph here. And you can see that it kind of lines up relatively close, or at least the directionality with U.S. GDP. And so we do get U.S. GDP this week. Unfortunately, we get it after the Fed meeting. The expectations are for a relatively decent print in the second quarter. This will be the first estimate that comes out on Thursday, and it's expected to be about 1.8%. You look at GDP now, it's been running around 2% or so, and it's really consistent with what we see from this weekly economic index. And so you have this kind of this economy that has been doing better than the expectations. I'll show you that in the next few areas. But you also had inflation that's come below expectations as well. So in general, you kind of have this like sweet spot or this Goldilocks scenario that's transpired the last couple of months where economic activity has picked up. And at the same time, inflation has been more disinflationary. And so in general, this is kind of the sweet spot for the overall economy today. And you can see here relative to expectations, what the economic surprise does, it says, okay, where is the economic data pointing today when you amalgamate a bunch of these economic indicators? What does that look like relative to the expectations from professional forecasters? You can see here that the Eurozone continues to disappoint. Yes, it's an uptick, but it's still very much below expectations. If anyone saw the data out there on the BLS report from Germany or the IFO lending standards out there in general, the IFO economic activity, it looks pretty ugly out there in Germany today. And so the Eurozone continues to disappoint. China's obviously been significant disappointment relative to expectation. The reopening trade was on the lips of every strategist at the beginning of this year. That has not, that at least has failed to materialize to date. But notice the U.S. What was it, like 60 to 70% of professional forecasters were saying the U.S. would have a recession this year. And what you see is that the economy continues to deliver above expectations. And so this is why you've likely seen a rally in risk assets, whether that's on the equity side of the equation. Some of that's been fueled by AI and some of those kind of thematic trades. But also you've seen it in credit spreads as of late as well. And again, this is kind of that sweet spot of the cycle that's being able to drive that. So the question is that will the sweet spot continue? Are we in this kind of no landing scenario? People talk about the soft landing, hard landing, no landing. The no landing scenario is getting a lot more play right now. And so let's take a look at some of the other indicators we look at to see if we think that this can continue on. And so one other way of thinking about measurements of the economy is to distill it down between manufacturing and services. And manufacturing is a smaller piece of the economy. Services comprise something like 75, 80% of the overall economy here in the U.S. And so what you can see here is that this is measuring economic activity. So when the line is below the 50 reading, that says that it's more contractionary. There's more participants that are saying negative things or a contractionary environment versus an expansionary. And when it's above 50, there's more response giving that in the affirmative. And you can see here that manufacturing has been really mired in this kind of contractionary environment for a long period of time now. It's been over 12 months at this point in time. But you notice it hasn't drug us into a recession. And that's because of the services continue to hold their weight. And in fact, they've had a couple of nice upticks. So we've had a couple of very low readings where they got below that 50 mark. We got that in the first printing of the year on the January print, which is from December data. And then we got another really low reading as of late. And in both cases, it's bounced off it. And so this is where people talk about the resiliency of the consumer. And I do think there is some merit to this. I mean, you're seeing that there is economic activity out there. Those last ISM services, everything about this report was very strong. You had this increase in activity. You had more jobs being created. You had lower prices paid. The input costs were coming down as well. So in general, all of these things are pretty accommodative. And so this is one of the few economic indicators that continues to be relatively, it remains relatively strong and does argue for us not going to recession in the near term. On the other side, we've seen a really big contraction in the credit conditions and the availability of credit within in the overall small to medium enterprise. And so this was obviously something that was a big concern, given that we saw the banking crisis or the banking challenges, whatever we want to call it, the failure of three banks back in March and April of this year. And you saw prior to that, even before we saw these bank failures, you were seeing a reporting of significantly tightening of credit conditions. That's an orange line. But then there was this availability of credit that really shrank up. And so this availability of credit in diminishing does cause some concern out there, is that small businesses and medium enterprise have been one of the lifebloods of the economy. That's where a lot of the job creation has transpired over the last 18 months or so. You see the headlines, the big layoffs are coming from the big corporations, but this has really been one of the areas where there has been strong growth. And so if conditions continue to tighten here, and also there is this lack of availability of credit, again, because of any stress within the small to regional banking sector, it could spill over to this part. So when we look at these, look at the NFIB surveys here, it's very important to continue to monitor this, as this could be something that says potentially as a harbinger of things to come. And why I point that out is that if you lose availability of credit, credit being the lifeblood of a lot of these corporations, was revolvers, some sort of term financing, it can spill over to the overall economy. Also, the other thing is that it's not shocking that conditions are simply tighter, because prime borrowing rates now, if you have a prime loan, the prime rate's 8.25, set to go to 8.5 tomorrow. So you already have the stress on there. Plus, by the way, there's typically a spread associated with that. So you're talking about the availability of credit. You're now borrowing the double-digit rate. So this is something to keep your eyes on. There's also something called the SLU survey We get that data print next week. It's a senior loan officer opinion survey out there, which talks about the availability of credit as well. So these will be things to continue to watch over the next few data prints. And another thing is that we've also noticed there was a meaningful contraction in C&I loan growth. And so although the loan growth is not negative here, this is with a one-year lag. What we notice is that the leading economic indicators tend to really push in the direction of loan growth as well. And so when you're seeing a contraction in forward-looking indicators, tends to, again, mean people are more cautious, and therefore we've noticed this in the loan growth side of the equation as well. So again, if there is, even though the capital markets are functioning well, that is corporate bonds, the leveraged loan market, this is something to obviously keep an eye on as well. And we know some of the deposit flight out there that's transpired at some of the banks. It looks like there may be a merger of two banks post-close today, or at least an announcement at some point this week, as one of these problematic banks is reporting earnings today. Sure doesn't look good when you're announcing that potential talks on the day of your earnings release. But what we found here is that this deposit flight that we saw, that's the red line going down since March of this year, mainly that money has showed up in money market funds, and that's that blue line. And why I point this out, this isn't something dramatic that no one else has pointed out to date. But what's very interesting about this is that this money market fund, I believe that this money, it went from areas where you're earning little to no money on your deposits, right? You're making probably basis points on the deposits you had there. Now you earn something with a 5 handle on it, right? Government money market yields 5, T-bills, depending on the part of the curve, 5.5, 5.75 in some instances if you're willing to go out almost to a year. And so what that means is that this money that's sitting in these money market funds, I think, is dead money for the time being, meaning that people don't really want to spend it. We saw an inflation print that was sub 3 in the last reading. You're getting 5 something on your money. Why do you want to go out and take risk in market today when you can be able to earn that? So I just don't see this money leaving money market to go buy stocks or to go buy bonds at this stage. I think people are very content earning 5.5%, or it's roughly, call it 5.25-ish, probably after tomorrow's Fed hike. And that allows you to really generate a pretty profitable return, right? Now, there's risk to that, of course, that you ultimately have to reinvest that money at some point. But as long as the Fed stays in this kind of elevated rate or at the levels they are today, that means cash rates stay the same. And so it is pretty interesting to see here. But I think this is another reason that you don't see a lot of money in motion, is because, again, it's a good enough type of yield to sit in the money market today. One other thing that you don't see very often, you can see here that the same store sales, this is weekly, so it compares year over year. The data gets released weekly. That's why it says weekly in front of it. But you can see here that typically, at least, since in the last 12 years, that you haven't had it go negative outside of a recession. And so now you've seen some contraction in same store sales year over year. Again, it doesn't mean that the economy is going to collapse, but it's one of those data points that says, usually when we get to these levels, it's worth taking a pause and looking at the overall economy. And so in general, what we're seeing is that there is some strength in the economy. There has been strength in the first half of this year. It's delivered above expectations, as we saw in the U.S., and it's something that's led to the rally in risk assets. So the question becomes what it looks like going forward. And so I think at this stage, higher rates are going to start to kind of leak into the overall system now. We're going to see more of kind of a curtailing of this economic activity due to these higher rates, plus the idea that cash earns such an attractive yield today that it's likely to actually defer some of that consumption and spending. Now, I don't expect that over the course of the summer. I think people are going to take their vacations. We're going to continue to have, a strong August or so. But I'm curious to see what happens once the loan forbearance programs go away starting in September, and you start to see a newfound payment for 44 million Americans called their student loan payments that they haven't made in 41 months. But let's talk about inflation, because that's what's going to continue to keep the Fed, their eyes and their foot on the accelerator of trying to keep the hikes. And so let's see what the economic data shows us on the inflation front. So One thing we like to look at are import and export prices. We call this kind of the old school way of thinking about inflation, because these don't have all these hedonic adjustments and all these tweaks and things that you get from the BLS. Just says, what was the price of this? We send it out. What do we charge for it now versus what we charged a year ago, and vice versa, and the stuff we pull in. And notice here that when we had the inflation, it's because the cost of goods, both imports and exports, were going up meaningfully. Now they're starting to contract a fair amount. And so this should put some downward pressure on prices. Speaking of, if you look at manufacturing input costs, the prices paid index, this is again one of these diffusion indices. Sub 50 means that it's contracted. It just means more respondents are saying that there's price decreases over increases. What that should do is put pressure downward on overall prices. If you look at PPI, these are the producer price index. So it's like what, the CPI is the consumer price index, the inflation rate that we end up paying, but the PPI tends to lead CPI. So when you see PPI coming down, the red line is the level here, and the blue line is the year-over-year change in the overall level. And so you can see that we're actually seeing the PPI actually be deflationary at this point in time. Now, this doesn't have to translate into lower prices for the end consumer, right? Another way of doing this is that you can keep the price constant. If your input prices go down, your margin goes up. But ultimately, this should have less price pressure on the overall input costs, and therefore could help kind of this disinflationary trend continue. Now, if you look at CPI, you can see that we had a massive drop down in CPI on this core side over the last couple of months. And a lot of that's been, due to base effects. If you actually look at headline CPI, which includes food and energy as well, that actually had the below a 3% rate. It was 2.97 if you're using 2 decimal points there. But you can see here what the main piece of driving this inflation rate today is shelter. And so when the Fed is saying that we're going to look at core services, that shelter, that's that yellow area there, I kind of scratch my head and say, why? First of all, core services ex shelter means we take out all the consumption of goods, right? There's no goods in there. There's no shelter, so you don't have to live anywhere. There's no food, so you don't have to eat. And there's no energy. You don't need to do anything. So if you strip all those things out, there's not a lot of inflation. Well, guess what, Jay? Look at the yellow shaded area over the last 30 plus years. What you see is that area, again, its contribution to overall CPI, it's almost relatively a constant number. Yes, in late 2020, it got a little bit smaller than in normal circumstances, but notice that it's never went negative over the last 30 years. So it just seems a bit disingenuous to really be focusing on this piece, as it's things like education and healthcare, which are practically indexed to inflation anyway. But if you take a look at the gray area, goods inflation, this is part of the story where we had the supply chain issues. And so the good side of the equation was driving some of this spike. But notice that blue area. Well, blue area is shelter. We all know what's happened with shelter prices. Today, we got Case-Shiller indices. They were a very strong reading month over month. I think on the aggregate, we're only about 1.5% off the highs that we set last summer. And so when you think about the pressures that are supposed to come from shelter and bring inflation down because they operate with the lag, well, all of a sudden now you have this tick up in house prices over the last few periods. Now, you get kind of mixed reading on rents out there as well, whether or not, it depends on kind of the urban area you're in, the suburban area, what rents actually look like. But in general, I think that it's going to be hard pressed for this number to come down meaningfully in the next couple of quarters. And so hopefully the Fed isn't just continuing to look in the backward, look in the rear view mirror and be backward looking. Inflation tends to be a backward looking phenomenon. It tells you what the inflation rate was, not what it's going to be. And so again, this is a chart that says the Fed can continue to hike as long as they want to. Obviously, the more they do, the more pressure it puts on the economy. But what you'll see is that it's really, even though we all had expectation of inflation coming down, if you look at relative to the consensus, what you see is that inflation's actually been delivering below the expectations for the last couple of prints. And so you can see the spike in inflation relative to expectations post-pandemic, but now we're starting to see some of that reversal. And notice here that the economy during the post-GFC era pretty much delivered below market expectations or below consensus expectations on inflation throughout the entire period. So the question is, will it continue to decelerate, or will it end up continuing to press up? And so another way of looking at this, if you look at where this is headline inflation now, because this is what a lot of the forecasts look at. But you see there that there's the Economist survey. You can see that dotted line. We've been using that for a period of time just to show how much the inflation was expected to go down, but it delivered even lower inflation. Some of that has to do with energy prices, by the way. If you look at the year-over-year comparison, this is near when we had the peak in oil last year after the Ukrainian invasion. And so you can see here the market implied expectations are that it goes down, it kind of stabilizes around the 2 to maybe like 2.5 to 2.25%. Well, let me show you on the next slide. It shows you exactly where it's at. This is different parts of the inflation curve. These are what we call the break-even inflation rate. This is the rate that if this inflation rate materializes, it makes you agnostic from owning tips versus nominal treasuries, or what we call treasuries. There, you can see the market pretty much says 2.25 to 2.35%. That's going to be the new level of inflation. And you can see here that we have for a while there, the market started to think that potentially inflation may be a little out of control in the next 5 years or so. But notice even at the levels we are today, yes, they're above expectations where we were pre the COVID environment, but they're not materially unanchored. And so when you listen to the Fed, they always talk about they never want inflation expectations to get unanchored. And so again, this also says that maybe inflation is indeed transitory, and we should all just be chill about it for a period of time. If you look at real yields, they've been on the move upward again. And real yields are important because, one, you can guarantee that you get this real yield. They will sell you, U.S. government sells you tips. If you buy a 2-year tips today, you get a 3% real yield. So whatever the inflation rate is over the next year, they'll give you 3% plus that inflation rate, and they'll do so for the following year as well. But notice once you get to the 5-year, you're kind of been anchored around this 180-ish level, really for the bulk of this year. And why this is important is that last year when we saw a re-rating of the equity market, a lot of it was attributed to real yields. Real yields going up, that affects the multiple on the equity market. And so I did have a question recently from a client saying, well, why if real yields are going up, why is the equity market so strong? Well, if you notice here, really the real yields themselves between the 5s, 10s, and 30s really haven't budged significantly this year. It's that 2-year part of the curve that the client was looking at that day. And so in general, this last push up doesn't matter as much in the 2-year part of the curve. If it does bleed over, we may see a little bit of stress on the equity multiple, which is the inverse of the earnings side of the equation. But in general, right now, this kind of moderate real yield behavior is very similar to what it's been most of the year. We all know about the strength of the labor market. If you take a look at this, it's usually when you get this uptick in the unemployment rate that it leads to a recession. So far, we haven't really had a meaningful uptick. We did two jobs reports ago. The household survey had all these self-employed losses that spiked the unemployment rate about 30 basis points. I think it was 27 unadjusted. And we saw some of that reverse in the last print. So in general, this isn't flashing you a warning sign at this point in the cycle. And this also allows the Fed to continue to be as aggressive as they want to be. Because we know Jay Powell's favorite chart is the one I'm showing on the screen right now, which compares the amount of job openings out there for the people who are available and looking for work. And that's defined as those who are unemployed, but they're still in the labor force. And so if you take the ratio of these, and Jay Powell talks about this, that's the black line at the bottom, what you see is that there has been some improvement in the picture. The gap between the blue and the orange line is closing a little bit, but in general, it's not as closing as fast as the Fed would like. And so, it's kind of perverse in some way when you think about the Fed. They're talking about slowing the economy down. They believe there's a relationship between the unemployment rate and inflation because they think wage growth is really what drives inflation. And therefore, in order to be able to get the labor market or be able to kind of slow the economy down, they essentially want job losses, or they at least want some better balance of the market. And this is the other chart they're looking at here in terms of wage growth. And you can see that the average hourly earnings have been declining. That's the red line. The part of this is composition mix, that there's been some of the lower end job creation on the lower wage front, or at least those that the wages haven't been growing as much. But also, if you look at that blue line, which is the Atlanta Fed wage tracker, which actually compares the same cohort, so it kind of controls for the composition of the labor force, you can see that that's been ticking down a little bit as well. But these are numbers that are meaningfully higher than anything that we saw in the last 2 decades. And so this causes the Fed concern. They like to see the directionality here. But again, I don't think that they're done with their fight at this point. So, the market says they're hiking tomorrow. We all believe the market. We all believe that the Fed hikes tomorrow. They're going to give you the 25 basis points. The market says there's a 25% chance of a hike at the September meeting. It's probably in the early November meeting that the next hike comes, if it does. And that's got about a 50% chance right now. So again, the market says you're probably close to the end of the hiking cycle. The markets did start to reprice this after the last Fed meeting when we saw more prompts. And so ultimately, we're late stages of the hiking cycle. The Fed, even though the Fed, once they get to terminal and they stay there, they're going to stay there for a period of time. So I don't believe, unless we're absent some significant deterioration in the economy, and I mean a meaningful deterioration, would you see a Fed cut in 2023? And so I think by the time the Fed gets around to cutting at this stage, it could be a little bit too late. And so there's a story making rounds on Bloomberg of an interview I did where it says I'm predicting doom and recession. It's going to be so deep they cut 100. I said, no, by the time the Fed cuts, they will probably cut 100 basis points. Why? Because they'll be late to the party, just like they were late to the hiking party as well. So let's go to markets. Let's see what the markets have been doing based on all this. And the first thing I want to talk about is volatility. And so these are forward-looking expectations of volatility. So these are implied vol measures. The red line is high-yield credit. Notice that line has been eroding since we got to the peak in rates last year. The green line, which is FX volatility or currency volatility, same thing. Notice that the equity market, VIX volatility, has also been a downward trajectory. But notice what hasn't, that blue line. The blue line is the actual bond market volatility. And so this is the equivalent of what it's the equivalent of the VIX, something called the MOVE. I can't remember exactly, but it's option volatility estimate. It comes from B of A. And effectively, it's very similar to what's on the VIX side. It's talking about forward-looking vol on rates. And you can see here that now the market is starting to price in a much more volatile rate market, even though we know that the Fed is getting closer to the end of the regime. So once bond market vol settles down, I just wonder what it's going to look like for the other markets, as really they're at some of their lower levels post-pandemic. And this is why there's been a lot of volatility. There's been a very neurotic market out there. We had the big rate hikes. It started late. The rate hike started in March of last year. And you can see what's happened is the market started to reprice this. You see 2s, 5s, 10s, and 30s, with most of them peaking around, as I said, early October of 2022. The 2-year got a little bit higher than that. The high still in this part of the cycle is, I think it's really the day before Signature Bank went down and Silicon Valley Bank went down the following day. I believe that was the high in the 2-year, if memory serves. But you can see how much it diminished and repriced. And all of a sudden, we've been on this upward trajectory once again. But notice that the rest of the markets aren't really corroborating this. Yeah, the 5-year got kind of close again. At some point, the 5-year is going to be the way you want to bet on the Fed starting to cut rates. I think that you get better bang for the buck in terms of duration versus the 2-year. But notice what's happened. 10s and 30s kind of, they've been sitting. It's tough for the 10-year to break above 4%. We did it on what I'll call the ADP day this month when the ADP jobs report came out. And it was roughly 500,000 jobs. It was north of 400,000. And the market really freaked out on that day. I think we closed 405 on 10s or something like that day. But it hasn't really held. And notice too, the long bond, same thing. That 4% has been somewhat elusive. And so it seems that the bond market is consolidating, even though you have this upward trend. I'd want to see much more pressure on the 4% level to really consider this a breakout of this kind of range bound that we've been in. But in general, what you see here is that, now there's an inflation premium baked into markets. 4% yield is very interesting, doesn't yield as much as cash. But I like to remind folks the reason for owning some of this stuff, especially the 10s or 30s, is that they can rally meaningfully if the economy rolls over. And to give that an example, or I should say to put that in perspective, look at page 35 here. And this is just the drawdown. So this takes peak to trough. So, that peak that you see, the last peak that you saw in the 30-year Treasury there, that's when yields were at their all-time low in the long bond. That comes back into 2020. I believe it was August of 2020 that you saw the lows there. And then you can see what kind of sell-off you had from that point in time. Now, I'm not saying that all of a sudden rates will go back to the lows. I think the long bond got down like 1% on a close basis. I don't expect it to go back down to those levels, but it would be easy during a recession for this to retrace half of this loss, meaning that you could easily make something like 20%. So again, for investors looking for some protection, this could be a place to put, this could be a way of putting this into a portfolio. Now, in our closed-end funds, again, because we're targeting a higher level of income, we don't have any of this trade on today, but it is something that we're thinking about. And if we start to see some more deterioration in the U.S. economy, which again, I don't expect in the very near term, but I could see that happening, later in this year. Potentially, it's a place to put on this type of trade in this portfolio or these portfolios. We all know the yield story. I like to go through a little bond math with folks, or what we call it around here, just math. But if you have a 4.79 yield on the ag today, and again, this is an unmanaged index product, you can buy ETFs that reference it. Look at what you can do to the yield in the Treasury market and what your returns will be. So you could take a 75 basis point increase in yield today, and you would still have a positive rate of return over the course of the next year. And so it's very important as an investor to think about, I think the number is 77 where you break even today. But it's very important for investors to think about is that where we live mired in this world where you had extremely low yields, you had a lot of interest rate sensitivity. Now today, you live in a world that actually can generate some positive rates of return. And by the way, let's just say the yield on the 10-year came in 100 basis points. This shows that you could do something in the double digits with a boring vanilla fixed income portfolio. If you look at the performance year to date, 2023 has been kind to most parts of the overall fixed income and floating rate markets. You can see here some of the best performers have been floating rate assets. Things like CLOs, especially at the lowest rated investor grade tranches, doing over 8% year to date. You can see leveraged loans themselves, even at the lowest level of the credit rating, the CCC rating, only did about 8%. And I remind you that this is in an environment where floating rate coupons and liabilities have went up for these corporations. And so been a very, very strong performance in this market today. But by the way, these loans carry at high single digits, in some cases, double-digit coupons today. Look at the strength in the high yield market. This is not reminiscent of a recession. The type of returns here, we've been led by the CCC part of the market here as well. You see emerging markets have done quite well. Some of that is the weakness in the dollar we've seen on a year-to-date basis. The ag itself has done 2.3, and the laggards here are the Treasury market, agency mortgages, things that are government guaranteed, and also the non-agency mortgage market. Non-agency CMBS market. And this is important because if you look at non-agency CMBS, prior to March of this year, they actually were generating a positive rate of return. It's been a lot of struggle in this area. As I'll show you, some of the yields have gotten to very wide levels in this space. And so when you look across broad indices, you can see here what this is the range of the last decade. So it takes all the trade days over the last 10 years and says, okay, what has the range been? That's the min and the max. You have the blue bar, which says on average where you've been. You can see on average, things have been a lot lower towards the bottom of those ranges and where we are today. And so you can see where is stress in the market today. Well, what we should look at is what's at the highest levels of those areas. Is it treasuries? Well, treasuries don't signify stress. It's a function of Fed policy, part of that. IG, maybe it's a little bit higher, but spreads are tighter today than when they started the year. I think we started around 125, call it, We're at the low 110s or so today. But look on the right-hand side, at least the third one from the right-hand side, triple B minus CMBS. Well, this is reflective of kind of what people expect within the commercial real estate market. And you can see here that we went from an average yield of about 6.8% today, that this investment grade rated tranche yields about 15.2. Now, does the market think that these are investment grade rated tranches? I don't know. Maybe we should compare it to high yield spreads. Let's see. What is high yield today? 8.3%. And mind you, high yield is a single B asset when you take the weighted average of the whole universe there. And a single B roughly asset, let's just call it the whole market, is 8.3%. Well, if you're getting paid double that, the market sure does not think that that's going to be investment grade. And in fact, the ratings agencies have a lot of these on watch. So you're going to see some significant downgrade pressure. It could create a very meaningful opportunity if there's some forced selling as well in that space. But also notice that CLO double Bs, pretty attractive. When you go down in some of this securitized credit, as you get into the lower rate and below investment grade tranches, there is significant yield. And so, given these are closed-end funds, they tend to run on the riskier side of the credit spectrum. Yes, we have some balance in the portfolios, but they do traffic more in these areas. You can see here what kind of yields you're getting in the lower credit quality tiers. And things even like double B, single B bank loans yield about 10% today. Single B emerging market corporate bonds, about 10%. Double B CLOs, 13.5%. Double B ABS securities, so these are MPLs or marketplace lending, about 13%. They do have risk in them, okay? But again, when you get a lot of 13s, if you can carry these coupons, they can be quite helpful. But you notice here that conduit, those triple B CMBS that I was talking about, the only thing that yields greater than that are triple C bank loans and triple C emerging market corporates. So I think you can kind of just intuitively glean from this and say, well, maybe those triple B CMBS bonds are on their way to a triple C type of rating. And so again, for those that say, well, they want yield, there is yield out there. Now, granted, this is going to be, you're going to have to pick your spots here. You're going to have to manage through this, but these are just generic index type of yields. And so we also know that if you look at the average dollar price, there's still the potential for a strong total return. And so what we do is we compare the dollar price of a lot of these sectors of the market to today's prices to where they were at the end of 2021 before the hiking regime started. And you can see here, look at those triple B CMBS again, 62 cents on the dollar on average. That is the average of the overall market. It's 62 cents on the dollar. So not likely that you're going to get par back at maturity on at least on all those assets. But again, the ability, if your recoveries are solid, you do the underwriting, there is the potential for a strong total return. Secondly, the other thing is that you don't have to hold these securities till maturity. You buy something, it's a bit cheap, prices rally in this kind of market that we're seeing today. Prices have been rallying. You can go and sell those securities as well. So there is something very attractive about today's market that it brings the tradability of some of these asset classes back into vogue. Now, the thing is, you have to buy something to sell something, or sorry, if you sell something, you got to buy something back in these type of portfolios. And so anytime you're trying to do that, you're trying to either improve the quality or improve the distribution yield of the overall portfolio. And so lastly, it's a slide I like to use about the distribution set. It's not just about yield. It's also about how much interest rate sensitivity you have. These are closed-end funds. They really don't try to look anything like the index. In fact, these portfolios look nothing like their respective indices. The indices are there to give you a broad sense of what those markets are doing. But you can see here that you don't have to take significant duration risk today in order to go out there. Now, obviously, things with very high yield and low duration risk probably have higher credit risk as well. So didn't want to put a 3D chart here together for everyone today, but just showing people that the opportunity set there is there. There's a lot of assets that yield 6 to 9%, and these are just broad indices. And so with active management, we hope to do better through a cycle. So let's get to the funds. This is why we're all here. Let's talk about what have we done for you over the life of the fund. So this is DBL, the Opportunistic Credit Fund. Over this period, and again, this goes back to January 2012, the AG did about 145 basis points. And on an NAV, we've done 465. So about 310 basis points per annum over the benchmark return, with about 100 basis points more of volatility. So I think we'd all take the extra 100 basis points, moves a Sharpe ratio up by a factor of 5 relative to the index. But you can see you're not without periods of drawdown. So those who sold back in the 2020 experience, they weren't rewarded as well by having to sell at those lower prices. But you can see here that obviously the toil of the bond market last year brought these funds down as interest rate repricing across the entire fixed income marketplace. If you look at how we generate the overall yield in the portfolio today, this is our yield to maturity contribution on the left-hand side. Just shows you that we use a diverse parts of the credit market to be able to do this across the portfolio. And so again, that 13% roughly yield to maturity on the portfolio comes from various sectors of the market. So it's not just wedded to any one single sector of the overall market. You can see there's not a lot of government-related debt here. Of that, it's primarily the agency mortgage market. The agency mortgage market is some of the cheaper levels that it had been in really about 15 years. A couple months back, it's tightened in a little bit. It still trades on a relatively wide OAS basis, and so we still like that part of the market today. You can also see the non-agency MBS positions have increased over the last year as we found some more attractive opportunities in there. We're not loading up the boat with meaningful amounts of office space and the likes, but we are being very calculated in the risk we're taking there. You can also see that the CLO part of the portfolio is a big chunk of the portfolio. Why? Well, we need to maintain at least half the portfolio in investment grade rated. BBB CLO does a great job of doing that. We're very heavy within this area. And again, these floating rate coupons have been very accretive to the overall structure. We still have a pretty decent slug in non-agency RMBS, and there's kind of some small positions in the asset-backed market. If you notice here, we don't have any high-yield corporate bonds. It all sits within the bank loan part of the market, as we're focused on some of those kind of lower quality single B assets there, where we think have pickup relative to the high yield market today. So again, pretty balanced overall. Notice the duration is quite low in the portfolio, about 3.4 years versus the ag being 6.3. And so again, we have the ability to take the duration on this portfolio when indeed we feel like it's time to do so, to try to balance out some of that risk there. But again, remember, we haven't done that like we've done in our open-ended funds, simply because we have a high distribution that we need to maintain through the closed-end fund structure. DSL, the largest of the three funds, came out in April of 2013, right before the taper tantrum. Obviously, kind of painful experience out of the gate because of that taper tantrum. You can see that we clawed back, had a credit event, clawed back, had the pandemic, clawed back, and then we got this kind of rough environment. So in a world where the global aggregate, as Stegs told you at the beginning, it's a global aggregate because this has a significant component being to emerging market debt. In a world that's giving you a negative rate of return, I'll call it zero return. That's fine. 1 basis point per annum negative, or zero is about the same. We've done about 264. So not the greatest world to be living in, but again, another 260 basis points of outperformance kind of relative to the overall mandate. What you notice here, simply higher yield to maturity. Why? Bigger allocations to the emerging market space. We still have a meaningful allocation to things that you saw on the other side of the portfolio. We do have some high yield corporates in this portfolio. Reason being, again, trying to juxtapose that versus the EM risk. This is actually some of the lowest amount in EM we've had. We've been as high as almost 50% of the fund. The 39% is some of the lower we've been, and we have a little bit more high yield for that reason. We actually added to the non-agency RMBS a few months back. Again, some of the CRT deals were pretty attractive out there in terms of the yield offer. Not as attractive today. They've rallied a fair amount. We still like the way that they carry. But again, not something we're trying to add to at this juncture. One thing that we have done is de-lever this portfolio a little bit. You'll see the same thing with DBL. Cost of leverage is going up, and that's one of the questions in the queue here. Cost of leverage, we're going to be tied to SOFR. With SOFR rates going up, in general, between these funds, we pay anywhere between 80 to 100 over SOFR today. And so, your borrowing costs are near 6%. So that means if you're buying securities, you need to make sure that they can outstrip that, or you have a negative carry on that trade. So our gross leverage is some of the lower levels it's been. Just as we get tighter in this overall cycle, even though dollar prices are attractive, yields are there, we just think it's the wrong time in the economy, especially given the cost of leverage, to be levering up in a meaningful manner. Just as a way of kind of our highest levels of leverage, we've been around 30% in these portfolios as well. So paying down that amount is a meaningful move there too. And we've kind of done it somewhat pro rata across various parts of the portfolio. So again, notice the dollar price here, 67 cents on the dollar on average. Again, assuming these things would come back to par, that'd give you a 16% yield to maturity. You know, look, that's write out some defaults here. You know, it's easy to see how this thing could do something in the 10 handles, though, just given the amount of cushion you have in those dollar prices and the amount of carry in the market. Again, you do expect in a portfolio like this, you will have some defaults. If you don't have defaults, you're not trying hard enough, is what our credit folks like to say, because you need to take some risk in these type of portfolios. And lastly, the latest to the addition of the family, what we call colloquially DILI around here, DLY, it's the Yield Opportunities Fund. You can see here, had a rough time coming out of the gate. This was launched right at the pandemic. We got this portfolio on February 26th of 2020. And you can see what kind of work we had to do to claw ourselves back by the end of the year. And so we were able to do that just in time for us to earn it throughout 2021. And then with the new hiking regime, kind of kick us back in the teeth again. So we've been slightly down since inception on this portfolio. Strangely enough, though, lower volatility than the ag. Isn't that pretty amazing that even given that kind of wild ride you've seen here, lower volatility in the ag on a levered portfolio since inception? So pretty interesting, I think that part is. But again, if you see throughout all these closed-end funds, 200, 250, maybe 300 basis points per annum above their benchmarks. And that's kind of our expectation throughout a full cycle as well. What does DILI look like? Well, DILI is much more diversified in terms of its overall credit. So it's the most balanced of the three in terms of the overall credit. DBL, when it came out, needed to be more mortgage-centric. Again, just given kind of the universe back then. That's the way the prospectus is written. DSL is more of an emerging markets focused fund, or at least a significant piece of it. And then the Yield Opportunities is trying to be much more diversified across the segments of the market. You see here, EM, non-agencies, high yield, loans, CLO, non-agency RBS, everything's roughly above 10% of the portfolio. Small piece in ABS. There's a couple of equities in there and some of our debt restructuring. But still, today, $82.75 price, duration still in that kind of 3-year bucket. Like if you notice, very consistent across these three funds. Still significant yield to maturity out there, much more diversified, again, and driving that from the other sides of the portfolio. So those are the three closed-end funds today. I'm going to let our compliance folks go through the definitions back here and some of our disclaimers. And what I'll do is go through the questions now. And so someone's asking about the dividends distributions from the closed-end funds reflect only the interest coupon. Can you increase your distribution yield by swapping out lower coupon dollar price bonds into higher ones? No, that's not the goal here. Yield is yield at the end of it. So yes, it is the interest coupon. But in general, if you're swapping those out, again, it all comes back into yield to maturity. So you could increase the distribution, but the goal here, if you look at what the distributions are on these funds today, they're very, very high levels today. And so as I was making comments about some of the other funds, is that we have delevered all three of these funds over the course of the last, let's call it 6 to 9 months. And that's just the sole reason as there's more risk out there in the market. The cost of financing is going up. And to us, that it makes sense to try to manage the cycle. Next is, I've heard investors say they value managers with gray hair. Okay. Do you find that you start gray people taking more seriously? Sure. Thanks, Nate, for that. I guess so. Yeah. All right. Anyway, next, holder of DILI. Can you talk about the current cost of leverage? Yeah, I just did that. It's roughly SOFR plus 90 or so. Again, we use the leverage. It's at some of the lower levels, even since the inception of the fund. And so, again, we're always looking at that kind of relative value. How can we try to maintain the distribution, not take too much risk, and also the cost of that as well. Someone saying, seeing Cal Muni funds carrying max leverage at 6% and Cal Munis pay 5%. Why would they do that other than fees? Well, again, your cost of leverage is expensive out there too. So they probably have some high yield munis in there that are trying to generate that. And so in general, I think that, the Cal Muni stuff is tough. Closed-end Cal Muni funds, full disclosure, I own a couple in my own personal account. It's tough to want to own those when you can just go buy the vanilla funds that have safely less vol in them at very comparable yields. So kind of a tough thing. I do own a couple myself out there. Probably a good chance to think about maybe trimming some of that as well. So thanks for the asset allocation advice that I try to give out here. Do you consider a leveraged bond fund like DBL, DSL, Dilly to be a good curve steepener? No. I know where your head is. Your head's saying, okay, you're talking about a curve steepener. I want to be, like the front of the curve is going to go back down, so my borrowing costs go down. But in general, it just depends on what that environment looks like. In order for the front end rates to come down, the borrowing costs to go down, the Fed has to be cutting. Why does the Fed cut? Probably because we're in a bad economic environment. So maybe after the fact, it becomes a curve steepener, meaning that if the markets are forward looking, your bonds probably don't do as well, especially if they're credit sensitive, and then the Fed cuts. So at that point, it would be a good curve steepener, but maybe not prior to that. So good question, food for thought. Let me think about it a little bit more, but that's kind of my knee-jerk reaction. Someone's saying unusual NAV activity on DSL. Not sure what you're referring to. Reach out to us at fundinfo@doubleline.com or call us on our hotline, and someone will answer that question. Someone's saying, given the recent risk-on rally, is now the time to rotate a corporate credit below investment grade into securitized below investment grade. And yeah, it's probably a good idea. I mean, we talk about high yield spreads inside of 400 basis points at the index level. I showed you some of these securitized charts. Not only do they give you yield pickup relative to that, but also they give you structural subordination. They give you some more protection as well. So in general, we like that part of the space. If you look at our funds, that's why there are more of those exposures there. And if you go back to the slides, we tried to show some of that through the yield profile today. Someone's asking, is now the time to add credit risk? I would say no. I'm not a seller of credit risk today. We have been improving the credit quality of our portfolios over the last, call it 12 months or so, but we've taken a pause at that our last couple of months of allocation meetings. And the reason to do so is, one, notice the economy doing okay. As I said, right, growth is coming above expectation. The disinflationary trend is there. The question becomes, will the inflation come back up? By the way, all the base effects that we're into in the inflation number that drove inflation down, they get more difficult going forward because the month over month number that rolls off next month is a zero. So if there's any inflation in the next month, that means the inflation rate year over year goes up. And so, from the standpoint of, of thinking about kind of where we are in the overall cycle, it's probably a tough time to be wanting to add to the credit risk. That said, we're maintaining it at this stage. There's also some tailwinds from the lack of issuance out there in both the corporate and securitized markets. I hear this from the teams all the time about the issuance being significantly below last year's level, or at least the last 2 years or so. And so that also creates a tailwind, especially as people are getting more into this kind of rosy scenario. So I think that one needs to pick some levels to talk about trimming that credit risk. Right now, we are continuing to ride this kind of risk rally for the time being. And we think that ultimately, at some point, you're going to want to have to cut some of that. So I don't think it is, unless you want to be a day trader or someone that's going to be very active in trading that position. Someone's saying the type of leverage we typically use lines of credit and or repo facilities. DBL tends to be more repo focused, but we do have lines of credit here. They tend to be 180 days evergreening, meaning that the counterparty needs to give us 180 days notice to be able to retire that line of credit. So that has happened in the past, by the way. We've been able to replace it. And so with these type of funds, people like to lend against them. So to your question about blow up risk, I'm not completely convinced it's there. Someone saying the health of the European banking system is a potential surprise to the markets. Well, the European economy sure does look a lot weaker. We still have ugly inflation data. As I said, those German data prints that we've seen this week have been kind of ugly as well. And so I don't know if it's the banking system itself that's the problem, but it sure does look like there is some challenges overall there. And that's why you see that European surprise chart at the very beginning. Why I included that was to show that. With interest rates expected to decline, what's your view on increasing duration? Trying to find the right time for that. That's the art of portfolio management. I'm not convinced that they're expected to decline in the near term. If we did think that was highly likely, we would be increasing duration. But the expectations are not for a decline in rates on our desk right now. We kind of think we muddle along for the time being. So we're hoping to get that trade right at some point. Were the pension fund problems in Great Britain a symptom of some wider problem? Maybe. It definitely shows how crowded the LDI trade is there, how they all own kind of the same trade, how they were all levered. That's been the very lucrative trade to do. Obviously, that blew up in their face this year. And you also see with the expectations that the Bank of England is set to continue to hike rates. Notice that they have an inflation problem there. Potentially, you could see another kind of scare, but I think that scare kind of got worked through the system. The other thing about the UK today is that if you look at something called Trueflation, so there's a website that monitors it. They manage all these transaction prices. It reminds me kind of the Billion Price Project, where one of I think it was MIT, put that out probably a decade or so ago. The Trueflation in the US is measuring the low 2%. In the UK, it's measuring like 11 today. I saw that come out on their website. So I do think that the UK still has bigger issues. I'm not sure it's completely the pension schemes out there, as they call them. Someone said, good answers. I'm in for another 100,000. Oh, that was a $100,000 question. Okay, sorry. How do I compare these three closed-end funds to publicly traded BDCs and mortgage REITs? They're different. BDCs are corporate. They have to have a certain market cap. There's a limit on it. I want to say it's 250 million or something. Maybe it's a little bit larger than that. Mortgage REITs are levered mortgage products. So the mortgage REITs, specifically, there's commercial, there's resi, and then there's hybrids as well. And so mortgage REITs, agency mortgage REITs use a lot of leverage to try to get you that distribution. Not completely a huge fan of the mortgage REITs today. You got to be careful of what you own there. There's a lot of kind of commercial real estate risk out there in some of those. So be careful. Don't treat them as a very kind of, it's a homogenous product. There's a lot of heterogeneity across them. And so be careful with those. BDCs, different. They tend to be more corporate focused. So I think that there's a place for all of these. And then views on EM versus high yield. That's a tough one today because, the EM market, I think if you're going to take EM risk, take the credit risk. If you're going to do EM, do high yield risk today. The problem with that trade is that if the U.S. slows down and the U.S. goes into a recession, EM is sure to suffer in that scenario. And so I know that the theme historically is once the dollar peaks, you're supposed to buy EM. That trade has worked since the dollar peaked. But my concern is that if we indeed go into a recession in the U.S., that the dollar becomes bid. And some of this has to do with historically, the Japanese are one that are heavy investors in our markets. But what we noticed as of late in the last 3 to 6 months, they've been selling U.S. assets to buy European assets because after hedging costs, they do much better there. So some of the downward pressure, I believe, that you saw in the dollar, at least versus the euro, was because of that trade. So if indeed the unwind happens and we have a recession, then the Japanese sell their euro-denominated assets to repatriate back to Japan, then you essentially get the selling the euro to bid up the price of the yen to bring those back. So in general, I like it better because there's a little bit more spread there. That's a risk asset versus a risk one. High yield is relatively tight, in the U.S., but it's tight for a reason. There's not a big maturity wall problem until late next year, early 25. And so that term financing helps them. So the high yield duration tends to be a bit shorter as well than EM. So I'm kind of mixed on that, Mohammed, as you asked that question. And if you look at the portfolio, something like daily supposed to be spread around, they're very comparable in their exposures. And so I think that's why I'm on the fence there. So with that rounds out our questioning. I appreciate everything out there that everyone has submitted today. Thanks for being patient with us on this longer call. We appreciate everyone's support of DoubleLine. And I'll be speaking at you again in October on the Diversified Fixed Income Webcast. Until then, take care for now. Bye-bye.